Welcome to the Techno Fundamental Report for May 11th. Rule number 1, never lose money. Rule number 2, never forget rule number 1. I think that's very applicable to where we are today. Steve Jobs, we must admit, this guy was a wonderful American. He invented the iPhone, he invented computers in the early days. So what he says here is so smart. It says, start small, think big. Don't worry about too many things at once. Take a handful of simple ideas to begin with, and then progress to more complex ones. Think about not just tomorrow, but the future. Put a ding in the universe. You know, when it comes to investing, you should look for small companies that can become big. The idea of buying trillion-dollar companies is something very hard for me to do. I just feel that you've got to find smaller situations. Now, I wanted to talk a little bit about the banking situation. This is what basically has happened. And Warren Buffett, again, another quote, only when the tide goes out do you discover who's been swimming naked. Well, back here in this period, and this is mortgage rates, this is the 30-year mortgage. These banks and these brokerage firms and these financial companies felt like, I believe, that interest rates were going to stay low forever. Well, in 22, we went from roughly a 3% 30-year mortgage to a 7% 30-year mortgage. That has never happened before. It's kind of a black swan event. Basically, it caught these guys with their pants down. They didn't hedge their portfolios, and as a result, they're having serious problems. Now, Buffett recently, over the weekend, spoke, and he said, American banks could face more turbulence ahead, but deposits are safe. And so he's basically saying that there's some changes coming by the regulators that could really cause some problems. And let's talk a little bit about that. So you may want to pause your video and note these key points, but he's basically saying that there's going to be stress tests. And, you know, this is my opinion. The stress tests, I believe, are going to be adopted from the European model, which if y'all remember, back in 2007, the European banks got crushed. And as of now, they're doing much better. They're actually doing better than the U.S. banks. And it was because they came in with new stress tests that really did the job. Now, it could be, and this is just a speculation, that one of the stress tests would be that on these mortgage portfolios that these institutions are holding, they may force them to mark to the market. In other words, if you bought a mortgage in 2022, right now, that mortgage at 2 or 3% yield would be worth about half of what you paid for it. So if they have to mark to the market, that would be a significant reduction in the capital of the banks. So it's just something we really want to keep an eye on. And these stress tests are probably going to be a good way to go. Now, I wanted to go back in time a little bit. There's a really good book I'd recommend called The Lords of Finance. This book is about the 4 central banks, France, England, United States, and Germany. And this is 1929 that they're talking about. And basically, one of the key points I thought was a central bank is a bank that has been granted a monopoly over the issuance of currency. So in other words, the banks back in 1929 were run by actually private banks. These were not public banks like we have today. Now, this is Montague Norman. He was head of the Bank of England. He was governor of the Bank of England in 29. And this article, and they start out this book by saying that he basically had a nervous breakdown. And it was a very difficult time, you can imagine. Now, as we look at the regional banks, this is a waterfall decline. This is not some run-of-the-mill decline. This is saying that the market is very concerned about the regional banks. Now, if they go through stress tests, there could be literally hundreds of banks that will fail to maintain the capital requirements that are needed. Okay, well, let's get into the market itself. One of the things, the first number I look at when I look at a company to invest in is what is the market capitalization? In other words, what's a reasonable price? So when you go back, like last week we talked about Home Depot. In 1991, Home Depot's market capitalization was $3 billion, $3 to $4 billion. Today it's over $300 billion. So when I look at an investment and I look at market capitalization, the first question I have to ask is, can I double my money in this investment over a reasonable period of time? So for example, back in 2019, we found Tesla. Tesla was about $100 billion at the time, market cap. And I had to ask the question, can this go to $200 billion? And I said, well, maybe it can, so let's give it a try. It went to $1 trillion. So the point being is, take a look at market capitalization as really a primary reason to invest. You want to have something that you have the potential to make enough money to hedge inflation and to make good returns. And if you're involved in just the big companies, and that's what's going on right now with the market, it's all the big caps that are pretty much driving the indexes. Be aware of that. Also wanted to point out gold, kind of pop it up, it doesn't look bad. Now this is a tough one too. I mean, how can you invest in a metal that pays no dividends or anything? And it's just something to be aware of, because it's basically telling you there's a lot of fear out there. And also that's why all the big cap stocks are outperforming, because it's my opinion that these large funds have to hide in certain investments, and they're going after the big companies. Now, this is something that I think is a key indicator right now. This is the NASDAQ down here, and up here is the number of new highs. Now, the problem we're having here is that we're just not seeing any buyers coming into this market. So if you remember the rally at the beginning of the year, the NASDAQ rallied up to 12,000, and it actually went to over roughly 200 new highs during that period. So we had some buyers coming in. Now we've, basically traced along here. Now here's the banking crisis. So since the banking crisis, we've gotten back to 12,000 on the NASDAQ, but note here, the number of new lows is, less than 100. So we were at 200 here, we're at 100 here. Now, this isn't predicting anything. This is just an observation. This is just describing what's going on right now. Fewer companies are making new highs as the indexes move up, because the indexes are driven by market capitalization, which is the big companies. Now, the other indicator that I think is most important here is the aggression index. We started to see some problems in here, basically consolidation. Now, we're comparing technology stocks to consumer staples in this particular indicator. Now, we're trying to get back above these moving averages. Actually, yesterday was a good day for the NASDAQ versus the Dow and versus the consumer staples. But this particular indicator needs to break out here before you should consider becoming aggressive. But we've been having to be defensive here for a long period of time. Now, on new lows, I just want to point out, now just think about it on new highs, new lows. When the market is having a bunch of new highs, it tells you that there's buyers. There's buyers out there. However, when you get a bunch of new lows, it's telling you that you got sellers. And so right now, the new lows on the NASDAQ have, they're higher than I would like. The new lows, now back here again, here's the banking crisis. You can see the number of new lows. Now, on this particular index, this is an equally weighted NASDAQ. In other words, when you've got Microsoft, Apple, and these large cap companies dominating the NASDAQ, when you have a market capitalization index, it's going to be skewed towards the bigger companies. Well, this is equally weighted. This is where they equally weight everything in the index, and you can see it's not making, it's not moving up here like the regular NASDAQ. It's basically underperforming. Now, I did want to point out, you can see here on the NASDAQ as we go, we're actually making a new high in here. But as I point out, just observing, we're not doing it on new highs. We're doing it on just a few companies that I think are being possibly moving into like a bubble-like territory. Because if things do normalize, and we sure hope they do, that money may pull out of those stocks and you'll see the problem. Now, the small caps, you can see this is exactly the thing. Now, realize in this small cap index, they do have financial stocks. And you can see it's just not doing well at all. So you got the large stocks running the market, somewhat deceptive. Just be aware of it. Okay, here's our 3 economic indicators. You can see here interest rates are in a downtrend below the 200-day moving average. Price of oil is in a downtrend and below the 200-day moving average. Financial stocks are below the 200-day moving average in a downtrend. It's just not a great looking situation right now. We just have to be careful. Now, let's think long term though. We got to think about the future, just like Steve Jobs says. You got to look to the future. This was a consumption cycle. This was 1980 to 2000. Baby boomers went from 35 years of age to 54 years of age. Young people spend money. Now the millennials turned 35. The oldest millennials turned 35 here. Now, are we going to continue to be in a consumption economy? And if you think of like what that means is like if you go to a third world country, they don't really run their economy on consumption. They basically sell raw materials like oil and diamonds and whatever. So the point being is we will continue, in my opinion, to have a consumption cycle going forward. Now, why is this important? Because if you go back and look at this study that was done over that 25-year period, in other words, this study was done from here to here. Okay, so this study picked up stocks in a bull market, bear market, and then a new cycle. All right, so if we go back and look at this list, I find it very interesting. I've been really spending a lot of time on it. You see companies like here's Home Depot. You want to find the companies that are going to make up this list in the future. These are the companies of the past. But I think it's interesting that when you're in a consumption cycle, the consumer discretionary and the consumer staples section of the study. Now, this is 156 companies that were the winners. These were the big winners over that time period. Now, the largest group had to do with consumption. The second largest group had to do with technology. Third largest group was healthcare. So, in my opinion, then the smallest group was energy. In my opinion, I think this is a perfect template for a consumption cycle. So what you want to try to do, and this is what we would recommend, we would focus on these 3 groups. These 3 groups made up over 70% of the overall winner database. So if you have any questions, please give me a call. Thank you very much.